Our webinar will start in about 1 minute. Hello, and thank you for joining. This is Michelle Savage with XBRL US. You are here for our webinar on the Data Quality Committee Rule Set 17. Our program today is sponsored by the Center for Data Quality, and you can see the names of the members of the center below: Topan Merrill, DataTrax, the AICPA, P3 Data Systems, Altova, Donnelly Financial Solutions, Certent, RDG Filings, Broadridge, and Workiva. So big thanks goes to the members of the Center for Data Quality for funding our program. Today, we have two speakers. We have Shelley Waveren. Shelley is the chair of the Data Quality Committee. She is also senior financial consultant at Topan Merrill. Shelley is going to tell us a little bit about the Data Quality Committee and give us some updates on where things stand. We'll then cover a few CPE questions. Just to note that we are offering CPE credit for the program today. So if you signed up, please make sure that you respond to the poll questions that you see at 2 points during the session today. And frankly, even if you didn't sign up, we can make sure that you get your CPE credit if you respond to the questions, and we can reach out to you later on to get payment and handle the administrative side of that. We'll then move into a review of the proposed Rule Set 17, covered by Campbell Pride, our president and CEO here at XBRL, and he's then going to cover a review of the final rule set for 16, which has been finalized and is now effective. And then again, we'll have a couple of CPE questions. As we go through the program today, you can submit questions to us by clicking on the Q&A link that you see on your screen. Just key in your questions and we'll take them through the program. And if you have any kind of technical issues, please contact us by emailing support@xbrl.us, and we'll do our best to get you back online. So with that, I'm going to turn it over to Shelley Waveren, who's going to tell us a little bit more about the center.
Okay, thank you, Michelle. The Center for Data Quality is a collaboration of public companies, service providers, and data users. Our mission is to address the public's concerns about the quality and usability of XBRL financial data filed with the SEC. Next slide, please. The focus of the Data Quality Committee is to identify issues that impact data quality and impair the ability to consume and analyze XBRL data. Based on input from the users, we develop guidance and rules that can be accessed free of charge by all users. We are committed to issuing rule sets 3 times a year. This year, we released Rule Set 15 in April. Those rules have been approved and have become effective on September 1st. Rule Set 16 was released in July. Those rules have also been approved and have become effective on December 1st. Then on November 15th, we released Rule Set 17 for public comments. The comment period is ending at the end of December for this rule set. We will go over the concepts of the rules covered in this rule set later in this presentation. Then throughout the year, we also provide input to the SEC staff and the FASB regarding issues identified in our work. This year, the Data Quality Committee had 2 joint meetings with the SEC staff, and that was in March and September. In those meetings, we presented the DQC rules to the SEC staff and discussed trends and errors that we see in filings. We also work with the FASB to create rules to detect and prevent errors, or just to make sure that filers apply the consistent tagging approach provided in the implementation guide published by the FASB. This slide that you see on the screen identifies the names of the members of the Data Quality Committee. As you can see, it includes data and tool providers, analysts, repairers, and also standard setters. We also have the FASB and IASB participating as observers. And in addition to this group, there is a data quality working group that meets twice a month. Michelle, can you go to the next slide, please? So this working group would propose topics for consideration and develop the DQC guidance and validation rules. Those participants are listed on this slide. We really appreciate these members' contribution to the development of the DQC rules. Next slide, please. Now let's talk about how the SEC ecosystem supports the DQC rules. We have been collaborating with the FASB to include a selection of the DQC rules into the US GAAP taxonomy. The taxonomy that includes the DQC rules is called DQC Rules Taxonomy. We know that the SEC supports the DQC rules because started in March 2021, the SEC ecosystem actually produces warnings for violation of the DQC rules that are included in the DQC rules taxonomy. Let's take a look at the next slide. The DQC rules taxonomy was first introduced in the year 2020. There were only 3 DQC rules in the 2020 DQC rules taxonomy. This year in 2021, 3 more DQC rules were added to the taxonomy. And as we are seeing the effectiveness of the DQC rules, and the DQC rules are supported by the SEC ecosystem, the FASB is now proposing to add 9 new DQC rules for the 2022 DQC rules taxonomy. Next slide, please. The rules that are approved by the FASB's acceptance program are included in the DQC rules taxonomy. 6 rules have been added to the DQC rules taxonomy so far, and this slide shows the 9 DQC rules that will be added to the 2022 DQC rules taxonomy. The first 4 rules that you see on the screen are related to DEI tagging and the date contest of the subsequent events. Rule 41 is to make sure that filers should not change the default member of a given axis defined in the taxonomy. Then Rule 43, 44, and 60 are related to tagging on the statement of cash flow. The last rule that you see on the screen, Rule 79, will flag an error if the filer has created an unnecessary extension for a member that actually exists in the standard taxonomies. In other words, the standard member in the taxonomy should have been used rather than the extension. Next slide, please. Filers are strongly encouraged to use the DQC rules before their SEC submissions. In this slide, you can see a listing of the DQC certified software. And on our website, there is also the free of charge validation tool that can be accessed by all users. That's all I have for this part of the presentation. I'm going to hand this back to Michelle for some CPE questions.
Shelley, thanks very much. Yeah, we're going to take our first CPE questions. So again, for those of you getting CPE credit for the program today, please pay attention to your screen. And here's our first question. How many rule sets does the DQC publish for review each year? Is it 1, 3, or varies each year? So we'll take another 30 seconds or so on this. Okay, just like another 10 seconds. So please be sure to respond. Okay, and I'm going to close down that poll. And the correct response is 3. There are 3 rule sets published each year. That's the typical plan for the committee. Okay, so the next question. The FASB Data Quality Committee Rules Taxonomy is set to have how many new rules added in 2022? Is it 15 new rules, 9 new rules, or 6 new rules? Okay, just another 30 seconds or so. Okay, we're going to shut the poll down in about 5 seconds here. I'll give you the correct answer. Okay, I'm ending the poll, and the correct answer is 9. There are 6 rules in the 2021 taxonomy, and there will be 9 additional ones for a total of 15 in 2022. So with that, I'm going to turn it over to Campbell Pride, who is going to talk to us a little bit about the 17th rule set. So Campbell.
Okay, thank you, Michelle. So we have a number of rules that we're adding in for V17 and they're available for public review. So we'll just go through each of these, and if you have any questions, put them in the chat about these. So the first rule we have here is lease cost cannot be negative. We have a rule that basically checks all the negatives. However, for lease costs, there are certain circumstances when they can be negative. And this is the situation where you have if you have a sublease and then you're subleasing out property or whatever it may be, and then the value of that is greater than the lease cost. So if the sublease is greater than the lease cost, then some filers are putting that as negative. So this rule basically checks if the amount is negative, then it checks that you actually have a sublease. If the sublease is greater than what your lease cost is. That's the only reason why this should be negative. And that was brought to our attention. So we updated this rule. So if you've had this issue in the past, then this should go away. It's been taken out of the negative rules, but it's been created. We have created just a special rule for this that'll just make sure that the sublease is greater. Hey, if we go to the next slide, please, Michelle. So this item here, this is lease allocation in the balance sheet. And what this rule is checking is we have a number for finance leases and for operating leases. You basically, if you've got in the footnotes, you will report the balance. You will report the amount of those of the lease value of the I'm trying to remember the name of it, what the value is in your balance sheet. And what this is reporting is it looks at the footnote, and then if you say, oh, okay, we've reported this amount in this line item on the balance sheet, what this checks is that to make sure that the balance actually on the balance sheet is sufficient to cover the amount that you actually have. So you can see on, for example, here, the finance lease liability has been reported for a value with other liabilities. So it's saying we've reported the lease liability and other liabilities. and the value of this element is recorded in this case 234,000 in the financial statements. But if that's less than the value that you've recorded for the finance lease liability in the footnote, then it's going to flag an error. There's just an inconsistency. So either that 432,000 is in another account, or the value for other liabilities has got some problem with it. So this is just checking that there's consistency between the footnote for both the lease liability, the finance lease liability, the operating lease liability, and also the operating lease right of use and the finance lease right of use of assets. So it covers those 4 different types of combinations of finance leases and operating leases for the current, the non-current assets and liabilities. So we go to the next rule. So this one, operating lease amortization. So the SEC had sent out some letters to folks. You may have got one of these, and may not have, but basically indicating that your companies have been using an extension element for the operating lease right of use amortization. This element originally wasn't in the US GAAP taxonomy, but it was added. And then it was added in the 2020 US GAAP taxonomy. But since filers had created extensions, the companies didn't go back and update those extensions for the fact that the FASB had added this element back into the US GAAP taxonomy. So what this rule does is it basically goes and looks at the element names and looks for extensions which are pretty close to operating lease right of use assets amortization. So it has some logic in there to determine that. And the logic to identify the extension is shown here. It's got to have those components in it. But if it has one of these things, does not contain the text that's listed there, then it won't fire. So if this rule comes up and you've got it is separate, it isn't the operating lease right of use assets amortization that's in the US GAAP taxonomy, but you're getting this error, then you can put one of these other words in the element name that are listed in row 2, and then that rule won't flag anymore. It also checks it's a duration, and that it has a debit balance. So it has a debit type on that expense. So basically, this rule is just to pick up that where, the point of this is companies haven't updated their extension element they had to create because the element didn't exist. It was added to the US GAAP taxonomy, and now we're just searching for that. So we go to the next rule, please. Okay, so this is a calculation check, and so this is really looking at the calculations for the primary financial statements, anything with the word statement on it. When you create your XBRL financials, it's going to pull those, and then it's going to go and it's going to look at the current reporting period, and it's going to take every subtotal that you've reported in the calculation, and then it's going to go and find those components and make sure that you've got that all the calculation, all the elements add up to the total in the calculation. This rule, there were some rules added in version 16 to check this as well, but those rules only operated where you had created a table and the values were dimensionalized. This rule kind of just closes the loop on those cases where values are not defined in an XBRL table. So it looks wherever you got the calculation, it looks where we've got any of the children, and it'll go back and it only operates on one period, as I mentioned earlier. And so then it'll go through and it'll calculate up all those values. So in some cases, and what this is picking up, in some cases, companies have not created a table to report data, but they've created a table in the footnotes for dimensional data. And then they've taken that dimensional item, and then in their inline XBRL, they've used that on the face financial statements, but they haven't created a table for it. So wherever you're using dimensional data or a dimension, you have to have a table for that to match where you're putting it in the disclosure. So this is checking for it. So you've got a couple of options to fix these. Is one, don't put a dimensional data in a non-dimensional table, or two, create a table for this information if you're going to dimensionalize it. So that's like if you wanted to break down, for example, property, plant, and equipment by different classes of assets or that kind of thing. If you're doing that on the balance sheet, then you're going to have to create a table for it. So this rule is checking for that. Go to the next slide, please, Michelle. And this is just continuation of that rule, and this is showing you the message. So for a cash flow here, and it's just basically telling you these are all the components that you've got, but the balance doesn't have. This is what the message will look like. We've tried to put a lot of detail into the message just so it can help you resolve them, resolve the issue. And so you can see here it'll say the element name and what was the amount that you've reported, and then what the total that if you're looking at the XBRL, what you get and what the total that was reported for the total, so that you can see what the difference is. And this could be, as I mentioned earlier, a number of things. One, you've done the dimensions wrong, or two, it just doesn't add up, or three, you've missed a calculation, or whatever it may be. Next slide, please, Michelle. All right, so what this rule is doing, this identifies those cases where the dimensional structure defined for the financial statements does not match what was actually reported. So the rule checks that all the networks that have a statement, so it's going to check the balance sheet, the income statement, the cash flow. It does not cover the statement of shareholders' equity. And it checks, and basically the first component, it checks those statements where no dimensions are defined. And the second component checks those statements where dimensions are defined. So the first part where no dimensions are combined, it looks where there's no XBRL table, and if a definition link base is defined for the statement, it's not. If it is not, then the rule will proceed to execute. So it goes through each item in the presentation link base, and then it makes sure that a value has been defined for the current reporting period, and then it checks if there's a dimensionalized value for that same concept. So this rule will report an error if the presentation concept has no default value in the current reporting period, but does have dimensionalized value for the concept reported in the filing. So what it's doing is it's saying we would, you haven't used a table for the statement, and you've got a presentation item, and you've got that in this presentation item in the statement, but you don't have a value reported. So it's like, why are you putting something in the balance sheet if you don't have a value for it? And in many cases, companies have put it in there is because they've got dimensions. So it's kind of like it's working in conjunction with the other rule just to make sure that the table structure is being set up properly. Then the second part of this rule, this works where you do have a table, and it goes through and it checks if each concept in the presentation link base, the financial statements has dimensionalized values defined in the reporting period. The rule checks if any of those dimensional values can exist in the financial statement as defined by the definition link base. And it reports an error if the presentation concept has no dimensionalized values appropriate for the table defined representing the financial statement. So in some cases, you could set up those presentations, but it might not match with what you have in the table. So it checks that as well. So it's really just looking at, I've set up a table for the financial statement. Are the dimensions that I've defined for it consistent with what I have for the presentation? And this can happen sometimes where the presentation and the definition link base get out of sync with each other. All right, so we go to the next rule. And this just basically gives you an example of what that is, what the problem is. So this is the problem. So we were seeing in filings companies had used dimensionalized values on the face of the financial statements, but had not included the related definition link base for that table for that financial statement. for that financial statement table. So it's just trying to get consistency in terms of the way that this is reported. This issue didn't really tend to be an issue in the past because people were using the SEC renderer and those items wouldn't appear in the SEC renderer. But now with inline, a number of companies are just looking at their inline reports and they're not necessarily looking at the SEC renderer. So we're kind of getting we were starting to see some mismatches. So this rule is just really, there's not that many errors like this occurring, but we just want to have these rules in there. So if this comes up, this is what they mean. Yeah, the next rule, please. Dimensional values larger than the default. So what this is dimensions really give you a disaggregation of a line item. So you might have assets and you might break it down by country, or sales and you break it down by country. And what this rule is looking for on certain axes is it's looking where if the disaggregated amount is larger than the aggregate amount, that case shouldn't exist. It could be less because you might partially break it down, but the aggregate total shouldn't be less than any one line item or any individual breakdown. And it doesn't do it for all axes, it only does it for a few. It does it for the property, plant, and equipment, for the class of stock, for long-term debt, products and services, finite life intangible assets, and the debt instrument axes. So if you had an intangible asset, and you said this is my trademarks and was worth 100 million, but you also reported that your total intangible assets was 30 million, it's going to give you an error. It's going to say, how can a component of your intangible assets be worth more than what the aggregate is? So this is just looking for that. And usually this is picking up cases where companies have used the, inconsistent line items or have reported something in the footnotes as a one-off, and that doesn't gel with what's in the aggregate total on the face financial statements. Maybe there's a scale error or something like that in the footnotes. Okay, the next slide, please. Okay, so this is an IFRS rule, and this kind of mirrors a rule that we have in the US GAAP rules, which is to just check that the dimensional values are equivalent to the values that are reported in aggregate. So, for example, if you had a value like land, but there could be a dimensional equivalent of that, which is property, plant, and equipment with the member land. Those two values should be equivalent. And particularly in the the shareholders equity section of the balance sheet, there's a lot of these cases where, for example, in the statement of shareholders equity, you're doing a disaggregation broken down by the components of shareholders equity. So this basically will check that all of those relationships hold. So if you report something as additional paid-in capital, it should be equal to stockholders equity with the additional paid-in capital member. So there are a bunch of these, and these are listed out in the rule, all these relationships. And what this rule does is it just makes sure that that those equivalents are actually equivalent. It has a tolerance in there as well. So if they're off by a couple of, like, if you reported in millions, it's off by like 2 million, it'll be fine. But anything more, then it's going to say these should be the same. It also checks like things like treasury stock, for example, would be positive entered as a positive value. But on the shareholders' equity, it's entered as a negative value. So it takes those inverse relationships into account as well. Okay, we'll get the next slide, please, Michelle. I think this is going to give us the error measure. Next rule is also an IFRS rule. These are earnings per share calculations. These rules are basically just checking that the division is working properly and you're getting the right results. So it's just classic earnings per share calculations, but these are being done for basic and diluted and for discontinued. So it's just basically doing it for all those combinations and just making sure that that data has been calculated correctly. Now, if you see any problems in these, or you come back and there's some issue for some reason that the earnings per share calc is done differently because there's some rationale for that, then please let us know. I'd like to get that feedback. These rules for public review, I know there's going to be some cases like this, so then we can build into the rule. If you've got some situation with convertibles or some situations step up or step down type situations, then we can basically address those. So if you have any issues when you're going through and doing the filings, please let us know. Okay, if we go to the next slide, please. Yeah, that's it. All right, so those are all the proposed rules for V17. So you can go to our website, you can read about those in more detail. You can run your filing on the website, and then it will give you back a list of if you've got any of those types of errors in your filing. You could go back and run prior period filings against that list as well, and then see if any of those issues are coming up. And then obviously going forward, if you see issues coming up and it's giving false positives, please let us know. We don't want to have any false positives. We don't want to have people having to look at errors that are not valid. So if you think there's something wrong with them, just drop us a note. Say, look, this is the filing. This is the error I'm getting. I don't think this is correct. And then we can basically confirm that's the case, or look into it and change the rule so that we're not generating any false positives. All right, so that's V17. Do we have any questions, Michelle, or are we good so far?
Sorry, Campbell. The only question we did get was a question from someone asking if they could have access to the slides later on, and we will be posting the replay, so the video recording of the entire call. We'll also be posting a link to the slides themselves, since that was a specific request for them. And also all of the content that you see on these slides, for the most part, can be found on our website. We include a complete listing of all of the rules in proposal stage, and also the rules that are in final stage, so that you can take a look at them. And again, as Campbell said, you can run the rules against your own filing, even the proposed stage rules, which is a great idea, because if you run them against the rules and identify errors, then it can help you get a sense for whether or not you agree with the error. Then you could provide us a comment on that. And also, as Shelley was mentioning earlier, these rules are being kind of slowly incorporated into the FASB DQC RT taxonomy. And so the rules that are in proposal stage now are very likely to be incorporated into future releases of that taxonomy. So it's a good idea to get your input in now, because these rules are being flagged by the SEC, somewhere down the road. So that was the only question that we had so far, Campbell. So if you want to go on and cover the rule set 16.
Yep. Okay, so DQC rule set 16, this was approved in November, and it's planned to go effect. Well, it is effective now. It's December 1st. So these rules basically address some of the concerns around move to inline, where less companies were looking at the Edgar renderer. So we were seeing some issues with dimensions coming up in the financial statements. You can show the numbers in the financials, but from an XBRL perspective, they technically weren't in the financials. So this tries to address those issues. So the main focus was really on trying to basically make sure that we're getting everything into the balance sheet, the calculating correctly, things coming from the footnotes are rolling up correctly. And so some of these rules basically came out of an effort to try and normalize a lot of the data that was coming into the SEC, and to try and make standard data sets out of them. And then these really reflect those problems. So version 16 was the start of that, and version 17 basically was a two-part effort to try and clean up basically the primary face financial statements. So through these two rules, it's really going to be affecting, you'll see the effect on those is really on the balance sheet, the income statement, and the cash flow. Just to give you just a summary of those rules again, I know we've been through them on previous calls. The breakdown of lease liabilities and assets across financial statement line items. So the first one was DQC 124, and this was just flagging an area where lease liabilities and assets are present, but have not been included in the presentation link base of the financial statements, and also, or you've made no indication about where those elements are in the base financials. So for the lease liabilities and the finance liabilities and the finance assets and lease assets, if you've got in the footnotes, you've made those disclosures that should tie back to the face financials. So there's a number of rules around that kind of support that. Missing components of equity axes. This situation is really trying to identify situations where we've got inconsistency between the stockholders, the equity, the statement of shareholders, changes in shareholders' equity, and the balance sheet. In some cases, we saw on the components axis, on the equity components axes, that was added to the statement of shareholders' equity, but you'd have a breakdown between common stock and preferred stock. Those members weren't being used, and the class of stock axes was being used instead. So it was really just, this rule was intended to tidy that up. And in some cases, we were seeing bleed through into the balance sheet where shareholders' equity stuff was coming through into the balance sheet. So this rule is just basically laying out how you should be structuring that so that you get consistency between those two statements. So we go to the next rule, the next slide.
Yeah, well, we do have another question. Question is, how does the FASB decide which rules they include in the DQC RT, and why don't they just include everything?
Okay, so why don't I finish going through these, and then then we can answer that question.
Okay.
All right. So for the next rule is 121, incorrect transition elements used. So there was a number of accounting standards that have been rolled out in the last couple of years, and the FASB had included those, had deprecated a lot of, they haven't deprecated them, but they've separated them in the taxonomy for elements that shouldn't be used if you've adopted the new accounting standards. They're still in the taxonomy because there are some companies, private companies, emerging growth companies that can still use them, who had a longer runway in terms of adopting the new standard, but those elements are still there. So if you use them, they weren't coming up as deprecated, but a number of companies had adopted the new accounting standards, but they were still using the transition elements. So this rule basically picks up those cases. So it looks what kind of filer you are, and then basically indicates if you should have adopted the standard already, it's going to basically give you errors for those transition elements. The next one is components of equity on the balance sheet. This rule looks to see if you've got components of equity on the balance sheet. You shouldn't do that because the balance sheet already has line items for all of those components. So it's just inconsistent across, can be inconsistent. A handful of companies were doing this, and then those values they were reporting there were not being consistent with what was also on statement of shareholders' equity. So this rule was just picking up that. So basically the main guidance here is if you've got a balance sheet, don't put the state components of equity axes on that balance sheet. There are line items to use to break down your equity components, and you should use those. If you go to the next slide, please, Michelle. Rule 119. This is income before tax equity method. So this rule was added because of some work that was done. There's some work published in the New York Times about tax rates and before tax amounts, and they had tried to do this work, and they tried to pull the data using XBRL, and folks were using two different elements to report the income tax before the equity method, and they were using something before the equity method, and they had no equity method, so there's another element that you should use instead. So this is really just trying to get consistency of reporting. So this rule is just basically going to say, don't use this element, use another element. It's just really to say, if you don't have any equity method investments, then don't use the element that indicates that you have. Incorrect line item reference. So this is basically for if I've got a finance lease or an operating lease, and in your disclosure, you'd say, this is my amount of finance lease liability, and I don't report it on the balance sheet, but this is the line item. You can find it on the balance sheet. What this rule does is then it goes and looks at the balance sheet and sees if that line actually exists on the balance sheet. And if it doesn't exist, if you said it's in other assets or other liabilities, and you don't have other liabilities on the balance sheet, then it's going to give you an error. So it's just making sure there's consistency between the two of them. This is really picking up cases where companies had put other liabilities member, or they had reported, they'd put the wrong, they'd indicated in the wrong manner how something, what line item it was in. So basically this is fixing those errors. And this is important because a lot of companies want to know where these lease items are sitting on the balance sheet because they want to reverse them out or they want to separate them. So it's important to get that correct. So this rule plus the rule we talked about earlier in V17, which makes sure there's sufficient balance to cover it, is kind of trying to cover that situation to make sure that reporting's being done correctly. Can you go to the next slide? Okay, so this rule here, 117, is this basically it says it evaluates if the dimensional values in a financial statement are equal to the reported sum. So for example, if you did a balance sheet and you said, this is my tangible assets, and then you did a breakdown of what those intangible assets were, it adds those intangible assets up and it makes sure that they add to the total if a total is reported. So on the balance sheet or the income statement or the cash flow, there's a implicit, it infers basically if I'm breaking something down by a dimension on those face financial statements, then they should add across, otherwise my balances, the balance sheet or income statement won't add. So this rule is just checking that that's the case. Rule 118 is kind of similar, and what this does is it only works on the required context. And basically what it does is it says, I'm going to go and look at the this calculated total that you have in the financial statement, and then it gets all the calculation children, and then it adds them up and makes sure they add. It only works where you have a financial statement table. If you don't have a financial statement table, the other rule that we talked about in V17 runs. So this will run only if you have a table, and then it goes through and looks at the children. And if you don't have a value for a child, it'll go and look at the dimensions and it'll add the dimensions up and tries to generate that value and tries to make a complete calculation. So then it can check that everything is adding across. So this is trying to address the issue where the calculations that you define you may get these inconsistent calcs and they're fine, but you don't really, rather save you going and trying to say, oh, go and let me look at every inconsistent calc and make sure that it's valid. This rule is intended to say, if you pass this rule, then those calculations should be consistent. So that's what this rule's doing. And this rule we've made a number of changes to this rule over the last couple of months. We got a number of false positives, and so we've moved to eliminate those. So hopefully this should be running pretty cleanly. But if you do get an issue for rule 118, please let us know and explain what the issue is, so we can just make sure that we've got everything covered. There are some situations where it doesn't work, so it's not going to go and add up things across the legal entity axes and make sure that they work. It's also, if you create like another statement and it's a breakdown like of a subsidiary, the calculations differ between the primary financial statements and the calculations you have for the subsidiary. This will check that. What you have to do is make sure that you have a calculation associated with each statement that you have, and then it'll work. Basically, go and it'll calculate those ones that are applicable. So this rule is kind of a little bit complicated, but we thought it was worthwhile to make sure that companies can easily check that their calculations are correct without getting a whole bunch of calculation inconsistencies, which most companies will tend to ignore, even though in some cases the calculation may actually be wrong. Okay, if we go to the next slide, please. So I think that's it. Shall we answer that question and we can start on the CPE questions? So
sure, that'd be great.
So you want to repeat the question, Michelle?
Sure. The question was, how does the FASB decide which rules to include in the DQC RT? Like, why do they not include everything?
Right. So the main reason for that is we try to have these rules out and running for a couple of years and get a lot of feedback on them. Once people start to use them and they see errors, then they come back. If there's an error, then we tweak the rule. So one of the primary reasons is to make sure that the rule settles down and that it's only ever giving correct errors. We try to go out of our way to eliminate false positives as much as we possibly can, because we don't want to produce a report which says, hey, you got a bunch of errors in it, and then people spend hours going through something to find out that they're all invalid. So we kind of err on the side of, let's make sure we have no false positives, and if anything is reported, there probably is a problem. So if you do see something a problem that's not, please let us know so we can get rid of it. And then that way, that also means that when the FASB incorporates these rules into the taxonomy, they're going to be pretty sure all of the exceptional circumstances have been run across in the last 2 years, and then they can put those rules in. So that's really the primary reason, because those rules, once they're with the FASB, the SEC will implement them and they'll come up as warnings. And we don't want to be in a situation where people are getting warnings for valid reporting situations.
And Campbell, there's a follow-up question to that. Are IFRS rules included in the DQC RT as well?
Because that's run by FASB, no, they are not. We would have to get the IFRS folks to include those in their taxonomy. Now, the IFRS is including rules in their taxonomy. The SEC hasn't adopted those as of yet. Those rules, however, if there's any IFRS filers on the call and have used them, they do generate a lot of false positives. The IFRS Foundation doesn't go through, they're trying to do it for, globally. Situations may be different in some of these jurisdictions. So they basically say, generally these items shouldn't be negative, but yeah, there might be some cases where they are, and they kind of consider them warnings. So we've taken those rules and we've implemented a number of those IFRS rules, but basically tightened them up so we don't get any false positives. So we have a low, the list of non-negative items is lower, and then we also make exceptions if you use different members on them and that kind of stuff. So that's really going to have to be a conversation we have to have with the IFRS. But since we've only recently started doing IFRS rules in the last 2 years, that's something that's we'll probably be working on in the next year or two.
Great. Okay. Thank you. That's all the questions that we have right now. Let's go to the CPE questions, and I'm going to bring up our next poll question. Okay, so you should be able to see this on your screen right now. Which of the following rules are out in proposal stage as part of Rule Set 17? Is it lease cost cannot be negative? Or number 2, components of equity on the balance sheet? Or number 3, incorrect transition elements? So we'll give this like another 45 seconds. Okay, just another 10 seconds. Okay, I'm going to close down this poll now. And the correct answer to which of these rules are out in proposal stage as part of Rule Set 17 is lease cost cannot be negative. So let's go on to our final poll question. Okay, which of the following rules have been developed only for IFRS filers in the proposed rule set? And again, that's Rule Set 17. Is it earnings per share calculation, incorrect dimensional items used on financial statements, or lease costs cannot be negative? Which of these rules is only for IFRS filers? Okay, about another 30 seconds or so. Okay, just another 10 seconds. Okay, great. I'm going to close down that poll. And the correct answer to which of these rules has been developed only for IFRS filers is earnings per share calculation. So I want to thank Shelley Waverin very much for not only for speaking on the session today, but also for chairing the Data Quality Committee. And thank you to Campbell Pride for walking us through Rule Set 17 and Rule Set 16. And I want to thank our audience for joining us today. CPE credit will be, you'll be emailed about that very shortly. And also tomorrow or sometime in the next couple of days, we'll be posting the replay or the archive from this session along with the slides themselves. And thanks again for joining us. We don't have any scheduled webinars right now for the new year, but we will soon. And so you'll be hearing about that from us. We're going to look into some topics that we're considering covering are things like ESG. We've been doing a lot of work on the ESG front. I'm sure many of you are aware of what's going on there. And we also have some more external data processing sessions coming up. So you'll be hearing about those soon. So just watch your email. And in the meantime, I hope everybody has great holiday time. Thanks again, and we'll see you at the next session.